Am I audible, guys? माझा आवाज येतोय का?
येस सर, येतोय आवाज.
Okay, thank you. Is the PPT is visible to you guys? Please confirm. अश्विनी, PPT दिसते तुम्हाला लोकांना?
Yes, sir.
Okay, thank you. Uh, in this subject, international finance, okay, we finished the first chapter, and in the last session we start with the second chapter. Second chapter is that is introduction to foreign exchange market. Okay, so in last session, so we understand the system of the foreign exchange market. Okay, we understand we can say uh, what is the daily transactions on across the border. You can say we see that is the how these transactions happen. Who are the participants in the foreign exchange markets? Okay, who actually regulates the foreign exchange markets? Or we see in the last session that there is no single regulators in the international markets. We know there are some of the different international bodies like IMF, World Bank, and the central bank of each nation. All these are the, we can say, the main regulators. We also find that the some of the central banks who provide the services to their customers to we can say to transfer the payments on the across the border, that is to make the international payments. So all this we see, that is we see the how the multinational companies exchange their goods and services, okay, across across the border. Okay, all this part we see in the last sessions. We also understand the structure of the foreign exchange market, that we learn in the last session that how we can say the no central exchange, or that means there is no we can say the single headquarter for the foreign exchange market. Okay, the electronic devices which are interconnected with the help of the different banks, different international financial institutions, and with the help of all these, we can say the foreign exchange market works. And we also learned in the last session that as we know, the timing of the working hours of the each and every nation is different as per there we can say the sunrise in each country. So that means the foreign exchange market has to provide the services by 24 hours in a day. So as we know, the foreign exchange market works for 5 days in a week. That is on Monday, Tuesday, Wednesday, Thursday, and Friday, and on Saturday and Sunday. The foreign exchange markets are closed. Okay, so we know this system, we understand the structure, we understand the different types of transaction. That is this, we can say the spot transaction of, we also understand the forward transactions, we understand the swaps options. Okay, so we will learn all these things. Okay, we understand the exchange rotations. I also told this part to you guys. So in these sessions, we are going to understand the we can say the how financial markets and currency dynamics works in the international market. Okay, in the foreign exchange market, how these things hmm, we can say works, that we are going to understand. Okay, so we can say the market approaches to investment. That means the investment success on the in the international markets is depend upon your daily analytical framework. Okay, uh, guys, we understand in the subject that is the security analysis and portfolio management. We understand what is the importance of the analysis in the investment part. Okay, so whenever the any investors wants to invest his hard-earned money in any of the companies, any of the industries, in any of the economics. So before doing this, there are the two type of analysis that we understand in the subject securities analysis, portfolio management. That is fundamental analysis and technical analysis. Okay, so we will first we can say mm, examine the primary approaches that the investor use to navigate the financial markets before doing his investment decision. So before doing the any business decisions or the investment decisions, the market analysis is, we can say, is one of the most important aspects of a business. Okay, we can say on international level, whenever any investor want to invest, we can say, so what is the efficient market approach? Okay, so for the efficient market approach, we understand, we can say the different what are their origins. Okay, if you follow that approach, then what are the implications of that? Okay, so is one of the examples we are taken here. We take the example that is developed by the economist, we can say the Pharma in the 1960s, that the efficient market hypothesis revolutionized how they understand the market pricings. Okay, so the one of the hypothesis is given by the economist Pharma, that is the efficient market hypothesis. In that hypothesis, we can say what he say, whenever the investors invest his amount of money with the great analysis, then he can efficiently gets the return. Okay, so the market is efficient or not, when any investor know this, whenever he do the fundamental analysis, whenever he analyze the some of the factor of the economics, that is the GDP growth of the economics, we can say interest rates in the economy, the employment rate in the economy. Okay, so when we analyze these factors, then we got to know that the economy, that it is the efficient market or not. Okay, so it is the hypothesis given by the FEMA, and if we invest in the international capital by analyzing all these aspects, then we can see if the market is truly efficient. The best strategy is a passive investing through the index funds rather than the active stock pricing. Okay, so these are the implications of the efficient market approach. Okay, so that we understand. So before doing investments, we know that there are the two type of analysis we did. Okay, I also taught you the two analysis, that is fundamental analysis and that is a technical analysis. Okay, so here is a brief introduction of the fundamental approach is given to us before making any investment decisions on the international level. Okay, so in fundamental analysis, we what we do, the in fundamental approach seeks to determine the company's true, we can say, underlying value. Okay, that means we know that sometimes by the manipulation of the market by some of the big investors or big financial institutions for their profit purpose, what they do, they manipulate the prices of the shares of the company. Okay, to make the profits. Okay, so we never know, the smart investors never invest his funds or the money before analyzing the fundamental financial parameters. That means first we analyze the financial statements, that is the balance sheet, income statement, as cash flow statements. Okay, in fundamental analysis, we analyze this financial informations, and based on that, a smart investors, we can say, takes a decisions. Okay, In second part, we analyze the management quality and the corporate governance. Is the corporate governance of the organizations is good? Okay, and we can say if there is the we can say the stability in decision making, if the decisions of the organizations, the history of the decision is not so good, good not that well, that we cannot take a trust on such organizations. Okay, so management should be a trusty organization. If we take the example of the Tata, Reliance, so these are the, we can say, the some of the trustworthy managements. Okay, so we can take the trust on such a management, so they can always think of the growth of the organization. So whenever the growth of the organizations, we can say, has done, automatically the valuation, the value or the wealth of the shareholders or the owners of the company also gets increases. Okay, so the management quality and the corporate governance is one of the aspects of the fundamental analysis. Now, next one is, we can say, the industry condition and the competitive landscape. Okay, so whenever we do the international invest, okay, so whenever we do the investment on the international level, so what do we do first? We can say we find it out the industry conditions. Okay, now in that particular country, how the particular industry is, we can say, showing a growth. Okay, if the particular industry is showing a growth as per the GDP of the economy or not. If the industry is growing at the less, we can say, percentage as compared to GDP of that particular country. Okay, so we can say it is not as per the, as we can say, the we can say wants of the investors. Okay, so and what are the competitive linkages? What are the different competitors of the organizations? So what are their what are the prices of their competitor as product? Okay, what are the quality of the competitor products? Okay, what are the, we can say, the technological innovations, inventions uh, that the companies showing and their competitors is showing. Okay, so when we analyze all these aspects, then we understand if the investments at the international level is safe or not. Okay, so and we can say some of the macroeconomical indicators and trends that we understand before doing the investment on international levels. Okay, the macroeconomical factors, like we analyze the GDP, that is the gross domestic product, GNP, that is the gross national product. Okay, we also understand what is the inflation rate. Okay, uh, we also understand the overall interest rates in the economy. We also understand first that is the employment rate, and we can say the unemployment rate. So these are the some of the macroeconomical indicators, and we analyze their trends. And after that, we that means the investors need to take the decision. So these are the some fundamental, we can say, analysis part that the investors first, we can say, do before doing the any investment decisions. So next part is the technical approach. So the price and the volume patterns, we can say, the chart analysis so identifies the potential in the historical price movement using the candlestick charts. Okay, so all this part actually we understand in the subject of the security analysis and portfolio management. Okay, so we understand that's how the trends, charts, pie charts, bar graph. Okay, we put the financial informations for over a period of time in the graphical representation, and from that graphical representation, the investors interprets the outcomes. Yeah, so that's we understands in the we can say in the technical analysis. So that's the basic difference between the fundamental analysis and the technical analysis. In fundamental analysis, what we do, we analyze the some of the important financial indicators. But in technical analysis, we put the we can say the some time period data into a graphical representations, and then we take the investors take the decisions of the investment. Okay. um, if you see in the diagram, the left one is the technical analysis diagram, and right one is the fundamental analysis. So in technical analysis, what we can say, for overall period of time, for we can say the 10 years data, 15 years, 20 years, so whatever years of data is available above 7 years. Okay. uh, so we can say in this diagram, we can say the candlestick graphs which we are shown in the diagram. Okay. So on that candlestick diagram that we can say analyzing the upward of the price upward movement for over a period of time. Okay, so that we seen actually in the diagram. Okay, so on that basis we can take the investment decisions. And in fundamental analysis, what do we do? That in this papers we have the financial statements of the organizations. So by analyzing the different financial parameters, the investors take the different decisions. Okay. So that first we need to analyze before we can say invest the funds in on the international levels. Okay, but for now we understand that is how global financial markets works, and how the interest rates affects the return on the international level, or how the interest rates decides on the international levels. Okay, so we can say the financial market transit borders, creating a complex ecosystems where the capital flows continuously across the countries and currencies. Okay, so here is the definition of global financial market is given to us. That is the we can say the across the border investment, or creating a complex ecosystem where the capital flow continuously across the countries. That means the in the global financial markets, the funds or the money continuously flowing across the borders. Okay, and they across the currencies. As we already see that the different country has a different currency. That means the each country has their central bank, and with the help of their central bank, every country print their own currency. Okay, so whenever the investment actually we made on the international level, so that investors are the across the countries investment and across the currencies investments. Okay, so this across the countries and across the currencies investment influenced by the interest rate differentials. Okay, that means when I invest, for example, if I take that the Tata is one of the reputed company or the group in India, so the Indian currency is rupees. Okay, so whenever we want to invest our fund in some other country, for example, if we take this South Africa. Okay, so when or for example, or we can take the example of we can say Japan, because recently our prime minister visited to Japan. Okay, now they are on a visit of the China. So while all these meetings, we can say the some of the across the border in decisions are taken by the leaders of the countries. Okay, if the India wants to invest in Japan, so Japanese currency is yen and the Indian currency is rupees. Okay, so the interest rates in India is different, and the interest rates in Japan is different. Okay, so how the investor make the adjustment with this? Okay, so that we are going to understand in this point, that is the global financial markets and interest rates. Okay, so first we understand what is the global market scenario. That is what is the scenario uh, uh, of the financial markets on a global level. Okay, so first we understand what is the we can say the what if we do the summation of all the stock markets of all the nations, then what is their value? Okay, if we made the summation of all the bond markets on the international level, what is the value? Okay, then we understand that is the what is the value of the world economy. So we consider here as the world as the one global village. Okay, and we understand what is the valuation of the different markets, that is the stock markets, bond markets, forex markets, are the derivative markets. Okay, so then we got to know what is the condition of the financial markets at the global level. Okay, first we understand what is the stock market valuation at the global level. Okay, if we can say the 106 trillion global market capitalizations. Okay, so this is, we can say, this is the three times of the US economy. That is, the US economy is near about the 30 trillion economy. Chinese economy is near about the 19 to 20 trillion economies. So currently the Indian economy is the 4.5 trillions economy, or we can say the 4.17 trillions economy. Okay, so that means the world economy, if we consider the summation of all the stock exchanges, like the some of the stock exchanges in, we can say, India's NSE, BSC, or we can say the Tokyo Stock Exchange, London Stock Exchange, Shanghai Stock Exchange, okay, Nasdaq stock. So we made the summation, so its valuation is a very big, that is the 106 trillion global capitalizations. Okay, in bond markets, that is bond market is, we can say, the loan market actually. So it is bigger than the stock markets, that is the 1 2 3 trillions in the global debt securities. Okay, the government and the corporate bonds. That means the big companies, big multinational companies, as and as well the government raise the fund through the loans for to fulfill their fund requirements. Okay, the uh, corporate or the big corporate houses raise the funds to enhance or to expand their businesses. We can say to raise the, we can say, funds or to fulfill the requirement of the working capital. Okay, or we can say for to fulfill the requirement of the long-term capital to create the different fixed assets of the businesses, plants, or whatever it may be, and the government raise the fund to fulfill the requirement of the budget deficits. Okay, so the bond market is bigger than the share market and at the international levels. Okay, if you see the differences of the 17 trillion, okay, that means it's the three times of the Indian economy. Okay, so next one is the derivative market. So derivative market is the biggest market on the international level, that is the 600 plus trillion notional value futures, options, and swaps. Okay, so next one is the forex market. That is the, we can say, the market in which we can say uh, is in the currency exchange. That is the 7 plus trillions daily transact trading. We can say we seen on the international level. So these we can say, so all these are the interconnected markets create the continuous global trading cycle with activity shifting from the Asia to Europe to the America throughout the 24 hours a day. Okay, 24 by 5, not 7, but we know that the on international level we consider the 5 working days a week. So on that basis, these are all the interconnected markets. So what is the valuations that we understand from all these numbers? Okay, so first on international level, we understand the interest rates and cost of the money across the border. Okay, how the we can say the interest rates we can say affect, and how the interest rates controlled by the different nations. Okay, so we know that the interest rates of the banks in every nation, we can say, are decided by the central bank of that nations. That is, as we all know, that in India, the interest rates of the bank is linked with the repo rate of RBI. Okay, so the central bank policy in monetary policy. Okay, central bank announces the monetary policy every quarter of the year, and in that quarter they declares the repo rate and the reverse repo rate. Okay, so repo rate is a rate, the rate at which the other bank takes the loan from RBI. Okay, if the for example the current repo rate is 5.50. Okay, that means the other commercial banks, nationalized bank, private banks takes the loan from the RBI at the rate of 5.50. Okay. If they takes the loan at 5.50, so the bank cannot provide the funds, we can say at the rate of 5, because they already takes the same loan at the rate of 5.50. Okay, so the bank wants some margin of profit. Okay, so that purpose the bank provide the loans to the lenders at the rate of maybe 7%. If they provide the loans at the rate of 7%, then 7 minus 5.50 to 1.5 percent of interest rate is there a profit margin. So according to the interest rate of bank are decided. Okay, so this is how the repo rate is linked with the interest rates of the bank. Okay, if the repo rate increase to 6 or increase to 7, increase to 8, so as per the increment in the repo rate, the interest rate automatically gets increases, because the banks wants their profit margin. So this is how the interest rates in each and every country decided. Okay, so we know that the foundation of the global interest rate structure set by the monetary authorities. Okay, so US Federal Reserve, that is the US central bank, decides the interest rates in US. Same likewise, we can say the European Central Bank decides the interest rates in Europe, Bank of Japan, People Banks of India, People's Bank of China decides the interest rates in China, and the Reserve Bank of India, RBI, decides the interest rates in India. Okay, so what is the global impact of the interest rates? Okay, we understand how the interest rates made the impact on global level. Okay, so the interest rate decision by the major central bank creates the ripple effect. So what is that ripple effect? Okay, that means influence borrowing cost worldwide. Okay, so whenever the any of the nations increase or decrease the interest rates, that means they increase the repo rate, automatically the interest rates in the country gets increases. If they decrease the repo rate, automatically the interest rates in the country gets decreases. So that influence the borrowing cost worldwide. Okay, if you say that the interest rates in India is higher, automatically that increases the borrowing cost. Okay, if I say if I require the loan for any of the business, but because of the repo rate of RBI, the interest rates in India gets higher, then automatically the borrowing cost increases. Okay, so that drives the international capital flows. The interest rates in each and every country decides the international capital flow. If we say that the rate in India is higher, that is the interest rates in India is higher, automatically the foreign financial institutions wants to invest in India, because they know that they'll get the more interest rates on their funds. If they provide the funds to the businesses in India. Okay, if the RBI increases the repo rate, automatically the financial institutions takes the advantage of that interest rates. Okay, if the interest rates in Russia is more higher than India,
then automatically that financial institutions divert their funds from India to Russia, because there they'll get the more interest rates. Okay, they receive the more interest, so that interest rates in each country drives the international capital flow. More, we can say, higher the interest rates, higher the capital flows in that nations, because the financial institutions want the more interest rates from the borrowers. Okay, so this is the ripple effect, we can say. The affects the exchange rates between the currencies. Okay, the interest rates also decides the exchange rate on the international level. We can say higher the interest rates in any country, that interest rate straighten that same currency on the international. So how this happen, we will see in the later part. How when we increase the interest rates, that automatically increase the currency's value on the international level. Okay, and we also see the impact of the emerging markets stability. What is the impact of the interest rates on the, we can say, market? Okay, is the what do at what interest rate the market is stable and what interest rate market is unstable? Okay, so that we understand. Okay, so impact of interest rates on the currency value. Here is one of the example is given, that is, we can say, higher the interest rates, then what happened? We can say there are two countries here. The example is taken, that is country A and country B. For example, country is India and country B is Russia. If the country A raises the rate to 4.5 and creating the 2% differential with country B, that means we can say the interest rates in India is 4.5 and the interest rate in Russia is 2.5. That means we create the 2% differential. Okay, so what that impact? Okay, this is how the capital flows, we can say, affected by this interest rate depreciation. Okay, so who is having the funds, who want to, we can say, invest this fund, who want to provide the loans to the businesses? Okay, that the investor seeks a higher return moving capital to country A to capture the rate differentiation. Okay, automatically who is the investor who gets the more interest rates in India in country A, because there is a 2% interest rate differentiation. In Russia, in country B, we can say interest rates are 2.5, but in India the interest rate is 4.5. So the investor seeks the higher return in country A. So that's why he is more interested to invest his fund into a country A, that is in India, because of these we can say interest rate differentiations. Okay, so because of the higher interest rates, capital automatically inflows in India. Okay, not in Russia. So that is, we can say, one of the implications of the higher interest rates. Now, next one is, we can say, the currency appreciation. I already told you that higher the interest rates, your currency on the international level automatically appreciate. That is, your currency is this strengthened on the international level. How it is? That is, the demand for the current country A's currency drives its value higher relative to country B. Okay, because the capital inflows. Okay, we can say the businesses glorify here in the country in India, because of the capital flow. We can say the huge businesses, we can say, start their businesses, and because these businesses, the different goods or services, we can say, we produce, employment increases, and because of all these, the economic activities, the number of economic activities increase, so automatically the GDP of the nation gets increases, and we can say the overall economic development of the nations we can say we've seen because of the higher interest rates. So automatically because of all this, the we can say the demand for the country is currency on the international level gets increases because of the economic development, and the demand for the currency of the country B, that is Russia, gets decreases because there are no economic activities we seen in country B because of the lack of capital flow, because all the capital flows in country A because of the high interest rates. Okay, so this is how the currency appreciations we seen on the international level. Okay, so this is the impact of the interest rates on the currency value at the international level. So, okay, so here one of the case studies given to us on the PPT, we see that is the 2024 US rate hikes. Okay, in 2024, what US do to control the inflations. Okay, actually, whenever we see the inflationary impact in the economy, what the central bank of the nations actually do, they we can say uh, they increase the interest rates. They increases the repo rate, automatically the interest rate gets increases. When the interest rates increases, the people not take the loans. Okay, they stop the purchase of the luxurious items. So automatically the prices of the luxurious items and the other item, we can say they stabilize because the people stop the we can say the because the people don't have the enough money because of they are not taking the loans because of the high interest rates. So that is the idea uh, behind to increase the interest rates to control the inflations. So what US do? US did the same thing. To control the inflations, actually, they increase the interest rates. When the Federal Reserve raised the rate to combat the inflations, the US dollar actually strengthened significantly against the euro and the Japanese yen, and reflecting the higher relative interest rates in the US compared to the Europe and Japan. That means in Europe and Japan, the interest rates are lower as compared to US. So when US further increase the interest rates, automatically the US dollars value on the international level get we can say increase as compared to European currency and the Japanese currency. So this is how so all these are the impacts of the interest rates on the international level. Okay, so for we now we understand the currency concept and its convertibility. Okay, now we understand what the currency is. Okay, we know the currency is the we can say is the paper which possess the exchange value. So that means with the help of currency, with the help of that paper, we can exchange that paper with the goods and services. Okay, so why that paper of a piece of paper has a value? Okay, so that is the first and foremost question that each and every finance student must have in their mind. Okay, guys, because if we have, we know at the time of that demonetization of currency, which did by the our Honorable Prime Minister Narendra Modi ji, we know that at the we can say when the he announces that all the 500s and thousands notes were out of we can say have the no values uh, from the we can say the 8 p.m. of this some date. Okay, so I don't recall the date exactly. But we know that all the piece of paper that is the 500 and the 1000 notes were just a piece of paper. Okay, so no, we can say the paper don't have any value. But okay, why the piece of paper now the 500 notes have the value? Because of the Reserve Bank of India gives the value to the piece of paper. Is whenever you see the any note on that note there is a note that
मैं धारक को that means I promise to pay the bearer of this currency. Okay, if the 500 note, that is the 500 rupees. That I promise to pay the 500 rupees to the bearer of the note. So that note is there on the each and every note of the currency, and because of this note, that RBI promise to the bearer. Okay, so that's why the currency has the value. That the each and every central bank of the nations gives the promise to in the same way. So that's why the piece of paper has the value. Now we understand in this chapter that the how this we can say the currency convert on the international level. Okay, so how freely they can exchange its we can say currency notes with each other. How how the different countries do the trade. Okay, and how they make the payments. So that we are going to understand in this session in this unit. Okay. So what is currency? What are the different types of currency that I already told you? What is the paper currency? Okay. These are some of the types of currency. That is the fiat currency. That is the government issued the money not backed by the physical commodities. Okay. So just I told you that the paper currency or that currency is the fiat currency. So this is the government issued money. That means the central bank of each country, which is the we can say the government body, who issues the physical form of paper currency. So that is the fiat currency. That is the value derived from the government decree and the public trust. Okay, so this is the fiat currency. Next one is we can say the commodity backed currency. That means when we convert the paper currency into the gold. Okay, uh, so when we can do that, we can if I want to convert my if I possess the 1 lakh rupees, I want to convert that 1 lakh rupees into a dollar. What there is one option is available to me that I can buy the gold with that 1 lakh rupees. Okay, and that same that gold I can sell and I can take the American dollars. So this is one of the way. So that means that I can purchase some valuable metals with the help of the fiat currency. Okay, so that we can say the gold or silvers we possess, that is also one of the form of the currency, and that currency we call as the commodity back because the gold and silver are the commodities. So that's why we call as the value. We can say the value tied to the physical assets like gold and silver. So that we call as the commodity basket currency. Okay, so historical examples, that is the gold silver currency. So next currency is the we can say the digital currencies. That is we know that the central bank now we can directly make the payments through the different UPIs which is available to us. Okay, so we can say in nowadays we make payments directly in the digital form, not in the paper form. Okay, so that in the we can say paper form. So this is the these are the digital currencies. Okay, so the central bank digital currencies and the cryptocurrencies. That means all these are the we can say the types of the digital currencies. That is the bank-to-bank transfer electronically. It is also the form of the digital currency. Okay, and the cryptocurrencies nowadays we know that cryptocurrencies. Some of the examples of the cryptocurrencies, the bitcoins. Okay, is one of the examples we can say. Now, how the currency convert, that is the one currency convert into the other currency. How what is the procedure? Okay, so we can say the fully convertible, that is the freely exchange in any amount for the other currencies without restrictions. Okay, so all these are the fully convertible currencies, that is the US dollar, euro, Japanese yen, British pound. So, okay, so in open market means there is no restrictions in that market. So openly with the help of the different market forces, that is the demand and supply of the currencies. I already told you the value of any currency is determined with the help of the market sources. Okay, that is the demand and supply. Okay, if the two nations agrees with the we can say the fixed exchange rate, so they can also do that. Okay, if for example, if I say the American president and the Indian prime minister, if they sit together and they decide, okay, in maybe in future that the $5 is equal to 1 rupees, and this is fixed for the coming 10 years. Okay, if they mutually decides, then that type of conversion we called as the fixed exchange rate. Okay, but to take the advantage of their demand of the economies of US, the demand of the US dollar on the international market, the US not agree with such a type of fixed exchange rate. Okay, so US always want the floating exchange rate because the value of their currency on the international market is higher because of the floating exchange rate, because of the demand and supply of the US on the international level. Okay, actually, how the global currency convert, we can say the this is the global, we can say some of this. Here is one map is given. That is the convertibility is not a static. Countries may gradually liberalize their currency regimes as their economies develop and integrate with the global market. Okay, so whenever we are in a good positions, okay, uh, we can make the agreement with the other nations. But if we don't have the any agreement, then we have to follow the open market conditions. That is the demand and supply, and the according to that, the countries have to exchange the currencies. Okay, so yeah, the many economies start with this. We can say the strict control and gradually liberalize as they develop the financial markets and build the reserve. Okay, so during the financial crisis, even the countries with convertible currencies may temporarily impose the capital control to stabilize the market. Okay, that is, for example, the we can see the US. They are having all the we can say capital control. Okay, so the uh, we can say they take the control of the international market. So the exchange rate, how they decide what are the types and what are the different regions that we understand in the next session. If you have any questions till now, okay, you can ask, or otherwise we understand all the exchange, that is the type of exchange rates and exchange rate basics in the next session. Okay, if you have any questions, you can ask. Or otherwise, we sum up the sessions, guys, you can leave the session. Thank you.